Hi guys! Today we're going to talk to you a little bit about the stocks Anheuser-Busch and Constellation Brands. A little bit of background information. We chose the consumer staple market because first of all, it is a non-cyclical sector, indicating that in this market, demand and earnings do not fluctuate during poor economic periods. Secondly, low price elasticity of demand indicates that as prices fluctuate, demand stays constant. And finally, this market yields a high return on equity. A little bit background on Anheuser-Busch. Between the years 2015 and 2016, this company experienced a large increase in assets due to a $100 billion merger between Anheuser-Busch and SABMiller. This merger effectively absorbed one of their two competitors in the U.S. market, with Molson Coors being the remaining threat. Effectively, 80% of the U.S. beer industry is now controlled by Anheuser-Busch and Molson Coors, with Anheuser-Busch owning 28% of the global market share and Molson Coors only 5%.
When we ran the numbers on Anheuser-Busch and Molson Coors, we found that Anheuser-Busch had much better potential for future profit. When you look at the dividend discount model, you see that they have almost $162 per share, but their stock price is around the mid-80s. So there's lots of room for us to profit from the future cash flows. It's the same when you look at the free cash flow model. There's plenty of room for Anheuser to grow and for dividends to be shared out to people who invest. Molson Coors also has a lot of room for potential profit, but just not as drastic as Anheuser-Busch. They just have a little bit more. So our long-term recommendation is to really buy a lot of the Anheuser-Busch stock. They've made themselves the hottest girl at the party, so to speak, because they've eliminated one of their biggest competitors in the U.S. market. They also control the largest share of the global beer market, and they've consistently grown their dividends for the last 8 years. It's also important to note that the consumer staple investing is very defensive in nature. Returns are low, but the industry is safe, and you can almost guarantee the returns.
The second company we chose to focus on is Constellation Brands. The most important information to note about Constellation is their 38% stake in Canopy Growth, which is valued at $4.2 billion. Canopy Growth is the largest grower and seller of marijuana in Canada and one of the largest internationally. Constellation says they have made this investment to diversify their operations and expand into new markets. Although this investment may seem exciting based on consumer expectations, we believe it to be a bad investment. As you can see in this chart, revenues for legal marijuana sales are expected to continue rising. Whether or not these projections come true is beside the point. The future expectation of marijuana legalization has led to a bubble similar to the dot-com bubble of 2000 or the housing industry bubble of 2008. The entire marijuana market is stacked up on illusions that it will become increasingly legalized, while investors forget that federal law in the U.S. or around the world still considers it to be a Schedule I illegal drug. This consumer hype will cause companies such as Canopy Growth to spike in the short term but fall in the long term. Not only is Constellation in trouble with their recent investment, they also have poor valuation comparisons. Constellation has a negative present value growth opportunity, meaning that they have a negative present value per share of future cash flows on growth, such as investing in Canopy. This is compared to the industry leader in many metrics, Anheuser-Busch, who has a PVGO of $22. Secondly, using the dividend growth model to find fundamental value, it appears that Constellation is severely overvalued in comparison to Anheuser-Busch, who is undervalued, further explaining why it is our long-term investment. Based on these negative factors, we believe Constellation should be shorted at the current price. We want to hold this position until it comes down in value with the crash of the bubble and finally close our short position and capitalize on decline.
In conclusion, Anheuser-Busch is a very safe stock. We recommend an ample investment here to almost guarantee a return on contributed capital. Constellation is currently overvalued and is investing into a market that is propped up on a bubble. We believe it is vulnerable to short. This is an inherently risky venture but could yield much higher returns in the short term.